Good afternoon. This is Clayton Puckett with TCG. We're the district's partner for retirement plans, as well as some of the information that's associated with that for your retirement planning processes. So again, Clayton Puckett, TCG. Here's my contact information if you need to get in touch with me on a going forward basis. Today's topic is Social Security considerations and how they apply to your TRS annuity. First thing I'd like to share with folks when speaking about these two things in Social Security is number one, your TRS annuity is never reduced by Social Security. I like to emphasize this because, basically what this means is your TRS, you're going to get all of it, period. The other side of that coin, though, may not be the case. Social Security can definitely be reduced by your TRS annuity. And there's two regulations that cover this. The first is the government pension offset. And what this applies to is any spousal Social Security benefit that you might be eligible for. The second regulation is the windfall elimination provision. And this is going to apply to your own Social Security that you've earned. So the first topic, the government pension offset, basically what this guy does is it takes 2/3 of your TRS annuity benefit and subtracts it from that spousal Social Security benefit. So again, this does not reduce your TRS benefit, but what this does is it uses a formula to figure out how much of that Social Security spousal benefit you might be eligible for. The current law exemption to this regulation is that if you work for the last 5 years of your career in a district that pays into Social Security, you may be exempted from this. So a example of this for you, if we look at a TRS pension of $2,100 a month, and we look at a spousal Social Security benefit of $1,000 a month, again, what we're going to do is subtract 2/3 of that TRS benefit from the eligible Social Security benefit. So in this example, we take the $1,000 spousal benefit minus 2/3 of $2,100, which is $1,400. Here we're going to wind up with a participant, a member that is not going to be eligible for any any Social Security benefit. The second example here, we're looking at a spousal benefit that's a little bit larger. In this case, again, taking 2/3 of that 2,100 number, we're looking at that Social Security benefit of 1,600 minus 1,400. Here, that member is going to be eligible for $200 a month as a Social Security benefit. So this particular government pension offset regulation can be pretty punitive to folks. So it's important to know that if you're looking at planning on this, you make sure you look into it, make sure you know what you're going to get. The next provision is a windfall elimination provision. Again, does not reduce your TRS pension benefit, but what this applies to is your own Social Security benefit that you earned. The first thing that I like to tell folks on this is in order to earn anything from Social Security, number one, you've got to have at least 40 credits. You can get up to 4 credits in a given calendar year. And basically it's 10 years of work history to get anything. From there, what Social Security does is they have a formula and a calculation to figure out how much of that benefit you are going to receive. And with this, there's, again, two important things to recognize here. The service credit eligibility is different from the substantial earnings eligibility for Social Security. So again, to earn service credits up to 4 per year, it's not that huge of an amount. It's $1,400 currently per credit. So a little bit less than $6,000 last year earned you a full 4 credits. The year of substantial earnings number, however, is substantially higher. So what Social Security does in looking at this particular provision, for those folks who have between 10 and 20 years of substantial earnings, you're basically going to get half of whatever Social Security says you're going to get. For those folks that have over 20 years of substantial earnings, basically the way that works is each year over, you're going to get an additional 5%. So, the important thing again to notice on this is, over the course of your, work history outside of education, you could have in fact accumulated all of your service credits without getting a single year of substantial earnings. In that case, you're looking at basically that 50% number. So if you're eligible, you'll at least get 50%, but you might get more. So the way to figure out the substantial earnings, number one, is we want to look at your Social Security statement. So if you haven't done this yet, what I encourage you to do is go to Social Security's website, set up your account, download your own statement to see all of your work history. And basically what this is going to show you is going to show you each year that you actually work with reportable income or income that was reported for tax purposes. It's going to show you what you earned and what of that was taxed for Social Security and what of that was taxed for Medicare. So in a lot of cases, what folks will see is, in the last years that they've been working under education, is your tax Social Security earnings are going to show up there as zeros because you're currently not paying into Social Security unless you're working a second job. So the reason we need to get this actual Social Security statement is what we want to do is we want to compare this to the windfall elimination provision to find out where we're going to fall in terms of years of substantial earnings. So if we pick a year out at random here, what we do is compare the substantial earnings threshold number to our actual earnings. In this case, if we look at year 2004, the substantial earnings threshold was $16,275. Go back to this example, 2004, the earnings here for this person were $39,000. So basically what this means is for that particular year, this person got one check mark. So to figure out, where the years of substantial earnings that we have, what we do is compare those two charts, go through them, figure out how many check marks we have. Anything that we have over 20 is going to add up to 5% more per year. Important thing to note on the chart here is when we look at the years of substantial earnings percent, it starts off at 20 or less, being 40%, the next year 45%. That's actually Social Security math. So the way it works is it works out closer to 50% with an additional 5% per year. You can get into it a little bit deeper if you actually want to go to Social Security's website, but for ease of explanation, gets pretty close to that 50% number per year. Other important notes on this is that the windfall elimination and the government pension offset are only engaged when your pension payment starts. So what this means for you is, you could possibly be drawing a pension, or you could possibly be drawing Social Security prior to drawing your TRS pension, and it would not be affected until you had that pension engaged. So the other important thing to note there is that if that TRS pension is never engaged, then you will never have a loss in income there. So for those folks that may have 4 or 5 years in the TRS system, and they're looking at the benefit being not much better than what their standard Social Security benefit is, in some cases it makes sense not to take TRS as a pension. Again, for decisions like that, it's important to look them over carefully and speak with them with an advisor to make sure you make the most beneficial decision in your situation. Additionally, important to know that the government pension offset also applies to widow or widower benefits if you have a spouse that passes away. For further information on this, I encourage you to contact the Social Security Administration at ssa.gov. Here's my contact information again. If I can be of assistance, please don't hesitate to reach out. Thank you.